underplaying the tension between the European Union and the US right now, publicly. Whenever I speak to someone from the US administration or the European Union, I get the same story. We all need to work together. What I actually see as an observer is a race for subsidies in the United States, the European Union racing to get its act together to do the same thing. It's a real tension starting to emerge. How are you going to resolve that? How do you actually truly work together when the US is spending a lot of time saying, let's build in America, make America, and then buy America? How are you going to resolve that?
Well, on this, and if we are to discuss specifically U.S. Inflation Reduction Act, EU has been very clear since the very beginning. So we definitely welcome the climate ambition of the Inflation Reduction Act, and the U.S. is also working on these goals. But at the same time, we have serious concerns about discriminatory aspects in Inflation Reduction Act. We have set up the dedicated EU-US task force to work on those issues, and indeed we are raising with these issues also bilaterally with US administration and trying to solve them.
The previous administration was heavily criticized for its approach to trade. Everybody would come on TV publicly. They had no problem saying it and criticizing the Trump administration. Is there any difference, any daylight whatsoever between this administration and the last one on trade? Can you identify one specific piece of daylight difference between what this administration is doing and what the last one did?
Well, first of all, with this administration, we were able to park several long-standing disputes, like Airbus-Boeing dispute, like dispute related to steel and aluminum tariffs. Right now, we are working on the global steel and aluminum
What's the status of that, Commissioner?
Well, just yesterday, I was discussing this with U.S. Trade Representative, Ambassador Tai, and there is a very intensive, very constructive engagement, and we are working with a deadline of October this year in mind.
We talk a lot about the relationship between the U.S. and Europe, both when it comes to trade, but also when it comes to military. We've been talking about these leaks that are very sensitive from the national security of the United States. Does that change your relationship at all with sharing information or doing business with the U.S.?
Well, once again, I must emphasize that in a situation where we see aggressive policy of Russia, I would say increased ambitions of authoritarian regimes, it's important that the democratic world works together. So yes, there are problems, there are difficulties, but we need to be able to discuss, overcome them, and find joint solutions as a response to current geopolitical situation.
Baris, you're very kind to give us so much of your time. Thank you for being with us, Commissioner. We appreciate it. Baris Dombrovskis there of the European Commission. Thomas, some really delicate issues right now between the United States and Europe.
They're huge there. And you talk about surprises of these meetings, and each meeting is different. And this has been, as I think Lupin Rahman said, an extraordinarily rich meeting. I'm surprised by the lack of discussion of year 2 of this war. The commissioner brought it up. He's one of the few to really address year 2 is different than year 1 of any given conflict.
We mentioned that in the last hour, Tom. The European economy is so different to what we expected 9 months ago.
Yeah.
This, in many ways, is the best case situation, and Lisa talked about why there's been a great effort to basically shift away from Russian energy, not out of choice, but out of necessity, and helped out also by the weather. Now, we've mentioned a few times this was one winter. Can we get through the second, the third, the fourth?
The third, the fourth, yeah.
If things are less favorable, but certainly so far so good. And that's largely been captured by the foreign exchange market as well. The fact we're back at 110, the ECB is able to talk about 50 basis point interest rate hikes with the frequency that it has done, speaks to an economy in better shape than I would say anyone anticipated 9 months ago.
I would go, as I mentioned, to the grandeur of the moment, the absolute lifetime shock of Finland being in NATO.
Yeah.
These are symbols that adjust the dialogue, every dialogue, I should say.
In the next hour, I'm looking forward to this conversation. Mohamed El-Erian dropping by the studio here at the International Monetary Fund Global Headquarters in Washington, D.C. That conversation up next. Don't miss that. Equity futures on the S&P just about unchanged. JP Morgan rallying in the pre-market. Numbers from Citi up next.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We can't declare victory yet. The great inflation isn't over until the Fed says it is.
Our expectation is that inflation will be conquered over time. It's not going to happen immediately.
The notion that this is inherently an inflationary economy is not obvious to me.
The Fed can't relax at this point on the inflationary front, even though, from the credit front, it probably should be a little softer.
Financial conditions have tightened to some extent, but it's really in the banking sector that we have seen most of the tightening.
This is Bloomberg Surveillance, live from the IMF spring meetings in Washington, D.C., with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
What a fantastic week, full of brilliant conversations, live from Washington, D.C. For our audience worldwide, good morning, good morning. This is Bloomberg Surveillance on TV and on radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Counting you down to retail sales in about 30 minutes from now. We'll recap some of the data for you. Yesterday, jobless claims a little bit higher than anticipated. PPI, factory gate inflation a little bit softer than anticipated. breathing some life into the bullish view on the equity market. Equity futures this morning just a touch negative off the back of bank earnings. And I have to say, bank earnings so far, so good. JP Morgan out of the gate, getting Q1 off to a great start. The stock is up by almost 6% in the pre-market. Lisa, Citi out just moments ago.
Yeah, beating pretty much across the board, but we're looking at the FIC sales and trading, fixed income currencies and commodities, coming in at almost $4.5 billion versus an estimate of $4 billion. $1.3 trillion of deposits. We will get the comparisons year over year in just a minute, but you're seeing that extension of the gain in Citi shares as once again, the big banks are the port in the storm, as you said, and we are seeing them consolidate their power, and that perhaps is what we're the story of the morning.
If you looked at these names, would you know we had a banking crisis in the last month?
No. No.
Do you have a clue looking at Q1, looking at the guidance from JP Morgan?
They're going to do everything they can to just underplay this, and they're going to play homage to the banking crisis happening with smaller bank America. I want to say, John, as a rule of thumb, and our next guest understands this, with Citigroup, you move the decimal to the left because they did a 10-to-1 reverse stock split when they were flat on their back 15 years ago. Citigroup is not JP Morgan. Citigroup is not Bank of America. Citigroup is not even UBS. They are a bank in restructuring mode right now, and it's great to see those numbers.
The stock is up by more than 3% in the pre-market. Here's a headline for you, Lisa. Jane Fraser, the CEO of Citigroup. Markets saw the third best quarter in the last decade in fixed income.
Yeah, that's exactly what I was watching, and I'm thinking to myself, of course, you take a look at the volatility that we've seen with rates popping all over the place, and you see all of the potential dislocations. This is when banks do the best. This is when you've got market makers that actually end up making bank, and that's what we saw with Citigroup. But that, to me, highlights the dissonance between credit crisis discussions and what the banks are doing with their balance sheets.
There's an extra level of detail we need, but looking at the early moves of Citigroup, the early move fades just a little bit. JP Morgan is still up by more than 5%, but a beat from JP Morgan, a raise as well for the rest of the year. You had a beat from Wells Fargo. It's on to next week, Morgan Stanley, Goldman Sachs on deck. Equity futures right now just about unchanged on the S&P 500. The guide through the next 30 minutes or so, your next stop for this market, US retail sales, and we're looking for a pretty soft retail sales print with a 10-year at the moment up just a single basis point, the 10-year, 345.62. We get lucky through the next hour. I'm pleased to say that alongside us here at the global headquarters of the International Monetary Fund in Washington, D.C., Mohammed Al-Arian, Bloomberg opinion columnist and Queen's College Cambridge president. Mohammed, good morning.
Good morning. Can we stop calling it a banking crisis? This was not a banking crisis.
Tell me why this wasn't a banking crisis.
A banking crisis is a crisis of the banking system. This was a banking tremor. A few banks that were caught offside and badly supervised went down. The big banks are just fine, and we're seeing that. In fact, the big banks are benefiting from this because they've got two things. Not only are they viewed as safe, but they've got diversified business models. And you saw what happened to FIC. You saw that suddenly it is the narrow bank that are riskies, and it's the universal banks that are resilient.
If it wasn't a crisis, why do you think that officials needed to use the systemic risk exception?
I think it crept up on them, and they just went a little bit too far. I understand why they did it. I suspect I would have done it too. Right?
Do you think they posed systemic risk?
I think the deposit run and the speed of the deposit run at First Republic scared them a lot. But this was a failure of supervision. We have to understand that this was a failure of supervision. We have enough evidence now to show the extent to which the Fed failed in the supervision of First Republic.
So let's say, absolutely, this is not a banking crisis. This didn't rise to some kind of 2008 or even, potentially that's a 1980s type scenario. But is it a credit crunch that we're going to see evolve?
Yeah, so we're going through a major transition which has made some business models incredibly stressed. And we're going to see that. We are now focusing on the banks. You just wait to see all the levered finance that has to refinance itself. We talked a little bit about commercial real estate, but it goes well beyond this. When you change the interest rate paradigm as quickly as we did, you will catch people offside. And some people will be able to get back on side. Other people have business models that doesn't allow to get back on side. Now, why am I saying this? Because some of the smaller banks have that issue. They have higher funding costs, that deposits have become more flighty, and they're going to have to contract their loan books. And they are making loans that the big banks will not make. So yes, we are going to have a reduction in credit contraction.
We've got to talk about the Federal Reserve. Raghu Rajan, a good friend of yours, I know, was fantastic yesterday, and I wish we were alongside him.
Connection
He was
lost.
talking about some of the blame lying at the feet of the Federal Reserve and the unwillingness of this institution that we're sitting in this morning to call out monetary policy officials for their role in some of the instability. Where would you stand on that now, Mohammed?
So I think it's very important to keep our central banks accountable. They are very important. As you know, I'm a huge fan of central banks, and when I criticize the Fed, it really hurts me. But it's important to have some accountability in the system. Why? Because that is the basis of political independence. And no one wants to erode the political independence of central banks. But central banks have to own their mistakes and have to learn from their mistakes to continue to enjoy something that is very precious and very important for the system as a whole, which is the ability to make policy without having to go to Congress.
One Fed official this week, in the last week at least, said the move from 0 to close to 5% in about 12 months wasn't the problem with the banking system. You've talked about a failure of bank management. Do you think that has anything to do with it? A decade of 0 interest rates and then going from 0 to 5 like that?
So we've had 3 stages of this tragedy. Stage 1 was too loose for too long. Remember, in March, when the inflation print was 7.5%, the Fed was still injecting liquidity into the economy. That's March of last year. We should have started tightening policy significantly a year ago. The second problem is that after this whole long period, the Fed mischaracterized inflation. So we lost 9 months of possible policy adjustments. When you start late, you end up going higher and staying there for longer. That is the logic. That is why timely policy responses are so important. So of course, this interest rate cycle has been mishandled. Of course, it has had an impact on what we are seeing in terms of not only financial turbulence, but also what we're going to see in terms of economic turbulence.
At your Cambridge, there is a spectacular stained glass window of a Venn diagram. It is just a remarkable stained glass window. There are 42 circles here at the IMF, and they're trying to find a Venn diagram of politics, economics, debate that gets to a common theme. I can't find the common theme this time around. What is it?
So I was surprised when in the 6 o'clock hour, you said there's all these issues and there's no common theme. There's absolutely a common theme. And the common theme is a world of deficient aggregate supply. We have gone from a world of deficient aggregate demand, that was the story after the global financial crisis, to a world of deficient aggregate supply.
Right.
You get inflation, you get interest rate hikes, you get more inequality, both nationally and globally.
Right.
And I could go down the list. And if you under-respond, if you under-react to that shift, then you start triggering all sorts of issues.
Brilliant. But the heart of the matter is, and Ambrose Evans-Pritchard absolutely nails this with a neo-Vixelian essay today in the Telegraph, the bottom line is there's too much money out there and not enough investable opportunities on a global basis. We've been this way for a while. Is it a generational issue where we're never going to escape this trap of just too much money chasing not enough constructive ideas?
So we certainly have too much money. What I would love to discuss with him is the notion that we don't have enough investment opportunities. We are going through major transition. The energy transition is a major investment opportunity. Let's talk about the market failures that mean that we haven't been able to take advantage of this important window in terms of investments. And we can have a long discussion about what the U.S. has done, and I know it upsets the Europeans, but they're right. They're trying to address market failures in order to have more private-public partnerships to invest in an area that is critically underinvested in.
A brilliant idea. Can he run the Port Authority in New York? Can Mohammed get us a tunnel?
Mohammed is raising a really, really important issue. This is not with the benefit of hindsight. We said it at the time. Germany and the European countries who had the luxury of incredibly, exceptionally low interest rates didn't make the move to invest in a way that they should have done.
Well, the way I would, in Davos, it's simple. There's all these fancy placards and marketing ideas of infrastructure and, McKinsey-like 80-page documents on development, and it just hasn't happened.
You don't remember when Wolfgang Schäuble left the German finance ministry and they all stood outside and did that black zero as if it was something to celebrate? It was a total failure of policy over the last 10 years.
Well, this is this word austerity, which really hasn't come up here.
And economic policy as well.
Are we going to see austerity in Britain again? I mean, within the shocks that we see now, Britain is so comfortable with austerity, aren't they?
No, unfortunately, Britain has become comfortable with low growth. That's the problem. We have three issues, and with my friends, people you know very well, Michael Spence and Gordon Brown, we've been working on this for a while. We have three issues. One is we have inadequate growth models. We have to rethink how we grow. Two, we have inadequate domestic policy implementation. And three, we have inadequate global policy coordination. Those are the three big areas. Now, there are solutions to all three. That's the good news. But we've got to focus the discussion.
The good news is this conversation's not over. Mohamed's going to be sticking with us. Mohamed Al-Arian, live from the International Monetary Fund Global Headquarters. Coming up in the next hour, we'll catch up with Aaron Cannon, the CEO at Clear Harbor Asset Management. From Washington, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. is pressing the need for allies to coordinate against economic coercion, not just military threats. This as Japan prepares to host top diplomats from the Group of 7 nations amid heightened tensions with China. U.S. Ambassador to Tokyo, Rahm Emanuel, saying, quote, that coercion piece is important. China is set to be a key focus of discussions at that meeting. China's mega banks are planning at least 40 billion yuan of bond sales, kicking off a major funding push to comply with global capital rules by early 2025. Bloomberg has learned Industrial and Commercial Bank of China and its 3 closest rivals are planning to tap domestic debt markets to sell a new category of total loss-absorbing capacity bonds as soon as June. Bloomberg has learned that Mitsubishi UFJ Financial Group's wealthy clients lost more than $700 million on Credit Suisse Group's AG's riskiest bonds purchased through the Japanese bank's brokerage venture with Morgan Stanley. Japan's largest banking group is holding meetings of senior officials to look into the matter as it reaches out to roughly 1,500 clients who lost a combined $717 million. And Supreme Court Justice Clarence Thomas and relatives sold 3 Georgia properties that include Thomas's boyhood home to GOP megadonor Harlan Crow in 2014. That's according to a report. ProPublica says that Thomas didn't list the real estate sales on his financial disclosure forms that year or report his extensive travel financed by Crow that occurred over 2 decades. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
I think the one thing that seems to be off the table in the discussions is the role monetary policy has played in creating financial fragility. And you have to believe that 3 crises in 2 decades, it has to have played some role. What about, for example, QE? Wasn't that part of what created the fragility that, in fact, we're seeing now? And that's why we need organizations like the IMF to start talking. They're very hesitant to complain about central banks of the industrial world because those guys have more economists than the IMF sometimes.
Can I just pick up on those comments from Raghu Rajan, the professor of the University of Chicago Booth School and former IMF chief economist, also led the Indian Central Bank as well. This line right here, on the lack of criticism of the Federal Reserve. They're very hesitant to complain about central banks of the industrial world because those guys have more economists than the IMF sometimes. Tom, what did you make of those comments from Raghu yesterday?
I think he's enjoying his independence where he's not a public official anymore. He was on fire, and let me explain why he gets cred. There were 4,300 books written on 2007, 8, 9. The short read, when I do college lectures, I go, shut up and read fault lines. And it's the concision. It's as Mohammed knows this, Mohammed's game theory, everybody's got a different act. Raghu is financial economics, which is algebraic concision. Think Loretta Mester on global steroids. Yep. That's what you're getting there.
We've got Ken Leon of CFRA standing by to weigh in on some of the financials. Just to wrap up Citi, Goldman and Wells Fargo, or rather Citi, JP Morgan and Wells Fargo this morning. We've also got Mohammed El-Erian alongside us this morning in the studio at the IMF headquarters. Mohammed, before we talk about the banks with Ken, I've got to get your response to Raghu Rajan. What did you make of that?
Of the criticism? Sure.
The lack of criticism of this Federal Reserve.
So historically, the IMF is very hesitant to, in any way, criticize the Federal Reserve, the ECB, but it finds it very easy to criticize central banks in developing countries.
Why?
Many reasons.
Can we touch on a couple of them?
Look at the voting power in this institution. Look at whose support you need to get these things through. I mean, it doesn't. I'm surprised you're surprised.
We're going to continue this discussion. We're going to go to Ken Leon here right now on the banks and get an update. He's Director of Equity Research at CFRA, but far more importantly, decades of experience in use of cash at these major banks. What's the future use of cash? I remember talking to Charles Peabody, Ken Leon, years ago, and he said, this is what they're going to do with their dividend increase. With the revenue joy today, can you model out a 3 or 5 year persistent use of cash to advantage shareholders at these banks?
Well, obviously, they don't have control of their book because regulators have quite a bit to say about return of capital like dividends, but they're investing in technology, they're investing in artificial intelligence. They're also durable banks, which means that assets are flowing in, not out of the largest banks. And what we will see in the future is an environment where how do you really maximize profitability in a slower growth economy? Again, what we learned today from the large banks is that net interest income, the higher rates year over year, is astounding. But that will become a more challenging comp in the second half of this year. So the operating businesses need to perform and grow, to your question.
Ken, did we learn anything today about what we are going to hear from some of the smaller regional banks, especially given that PNC did come in better than expected? But again, these are the biggest of the small ones.
So our financial team at CFRA, we're looking at everything closely. But again, the smaller banks have really a different risk profile, as Mohammed mentioned, in terms of, flighty deposits. So the ability to be diversified and also have a business where they can continue to lend. I also like Mohammed's other point here is the smaller banks lend in areas the large banks don't, which is really commercial real estate or construction activity, or to small businesses. So they play a vital role in the U.S. economy, but it's a more tenuous position as a bank versus the largest ones that I cover.
Let's wrap it up, Ken. Ken Leon there of CFRA on the latest financial results there. Tom, do you want to weigh in just quickly?
I'm just going to weigh in with we're in denial going back to 1833 and Andrew Jackson about how you run a national banking system. The U.S. model is unique, cherished in this Washington, tested every 5, 10, maybe 15 years. We're in one of those tests right now. And there's one simple answer, as Gerard Cassidy talked about. We're going to come out at the margin with fewer banks.
Fewer banks.
Yeah, 4,000 down to 3,000.
Mohammed can talk to you about what's happens in the UK. If you go to some rural town in the United Kingdom right now, there are no banks. Maybe this truck pulls up, and quite literally, no exaggeration, you get this small truck that might pull up a couple of days a week, and people will come out and do their daily bank, and then the truck goes and disappears. We've seen closures across the country for years.
I know you want to get back to the Fed discussion with Mohammed, but let's address this. Is the Canadian model better than the U.S. model in banking? I mean, you sat on the chair at PIMCO where you had to deal with that kind of thing. Is a 5-bank model better than what we're doing here?
That's such a hard question. That is such a hard question.
We don't do it in the 6 o'clock hour. We do it in the 8 o'clock hour.
But even if it were a better model, we're not getting there. I think we're going to lose a few banks. But the bigger question, Tom, and Lisa, and John, is what happens to regulation? Because you may get a regulatory overreaction to what is happening.
That's what Spence would say.
Okay. Well, I would say, Tom, the better question is, who for? Who's it for? You know, is Canada better? Who for? The banks, the big 5?
That's fair.
Or is it for the individuals that have to bank? Because I'm sure there's many Brits who are listening to this right now and thinking, well, it's not good for me. If you live in a rural town and you can't go to the bank anymore, it's a frustration. It's not a good thing.
So I should tell you a story. When Silicon Valley Bank UK was taken over by HSBC, I was doing a panel in Cambridge, and there was a venture capitalist there. And there was a startup person there. And I said, tell us, what's your reaction? Startup person says, you know, I went to HSBC to get a loan. They rejected me. I then went to Silicon Valley Bank. They gave me the loan. Now I'm a client of HSBC. I don't know what's going to happen to me. And
that's brilliant. That's in the zeitgeist.
Mohammed, that's
Lisa,
such an important way of framing it. And Lisa, I think that's why some people were almost bemused that the individuals that I would say had some part of blowing up SVB, that was the bank that banked their community. And then they exacerbated the bank run in the way that they behaved. I will never understand that. I will never understand that. They looked smart because the bank collapsed and their money wasn't in the institution anymore, but ultimately they were screaming fire.
Which raises a question, especially when you started out and said this is not a banking crisis, this is a banking tremor, and you said this was something else. Do you think that the IMF has been too negative and taken this and basically run with it and said, you know, the actions of a couple bad actors can be extrapolated out to everyone, and oh my goodness, we're on the precipice of something major, when Janet Yellen of the Treasury is more right?
So I've been consistent on this from day one. Even when Bloomberg Economics came out and said U.S. recession is 100% probability, that no, there's nothing certain about the U.S. recession. We can avoid it. I still think today we can avoid it. The probability has gone up. I'll give you that. But we can still avoid it. We only get there if we continue making mistakes. This economy is fundamentally sound. It's fundamentally sound. It's that we get in the way of it and we trip it up. I don't know if you saw the Economist cover this week.
I did, yeah.
But it is trying to explain, you know, why is the U.S. economy surprising on the upside, and what are the lessons to learn from that? And there's a lot of lessons to learn from that.
Do you believe in the theory that you should take the other side of the Economist cover? I'm thinking of Brazilian covers in years gone by.
I mean,
anything to that?
That was the reaction I got when I put it up on Twitter.
Yeah,
right.
I'm sure it was. The magazine cover, you've seen that? I think it's a tall horse, isn't it?
Good.
Yeah. The U.S. economy riding high.
Riding high.
The heart of this, within the econobabble, I'm going to call it 3 ratios with 6 opportunities, and we devolve it down to this thing, productivity.
Okay.
And the heart of the matter is every conversation we have, and in morning TV we don't talk much about it, but the fact is you get to productivity.
Absolutely right.
You know,
Absolutely. We haven't invested enough in people. We haven't invested enough in other things that enable growth and enable productivity. That is unfortunately the big mistake we made for the last 20 years.
Retail sales coming up in about 5 minutes' time to build on some of the data we've had so far this week. Jobless
Is
claims
Mohammed
yesterday.
going to tear it apart for us?
Jobless claims yesterday a little bit higher than anticipated. PPI, factory gate inflation, a little bit softer. I have to say, economists on Wall Street looking for a pretty negative print on retail sales. We'll catch up with Ethan Harris of Bank of America, and we'll get the Mohammed view on the US economy and what the Fed would call the totality of the data. What is the totality of the data?
Totality.
From Washington, this is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Retail sales data, just seconds away, 20 seconds away to be precise. Going into it, equity futures on the S&P 500, totally unchanged. In the equity market, on a single name basis, JP Morgan flying after beating first quarter estimates and raising their guidance for net interest income as well. That gives the financial sector a lift this morning. JP Morgan up by 5.8%, Wells with a beat up by 4%, Citi up by 2.3%. Getting some data, some retail sales. We were looking for a soft print. You get an even softer print. Here's Mike McKee.
Yeah, it looks like Americans stayed home, and some of those warnings we got from the credit card companies are coming true. Retail sales headline down 1%. That compares with a 0.4 decline the month before. And then retail sales ex-auto down 0.8, and that is compared with a 0.1 drop the month before. Now, the control group, which is what economists watch, down 0.3. That was down from the 0.5% gain the month prior. So all in all, it is not a particularly good report on in the retail sales numbers. We knew autos were bad, and now the rest of it looks bad too as well. Quickly giving you the import price index down 0.6, and ex-petroleum down 0.6. So some good news on the inflation front, but not good news on the consumption front. I'll let you check the markets. Let's see what we can find out about where the spending was during the month of March.
Hey, Mike, we'll come back to you in a moment. Stay close. Your equity market basically unchanged on the S&P 500 to slightly negative, even with those better-than-expected numbers out of the financial sector. In the bond market, yields a bit higher by 5 basis points. Lisa itching to explain this one on the 2-year, north of 4%. On a 10-year right now, Bramo, up 3 basis points to 3.48.
This makes sense to me. If I look through these numbers, my knee-jerk reaction is how much is just because gas prices were lower? Because right now you're seeing retail sales, ex-auto and gas, down by 0.3% versus the estimate drop of 0.6%. Are we just simply seeing the nominal effects of gasoline prices dropping in the face of a potential decline in the economy?
Yields up, Tom. 6 basis points at the front end, back 3.4.
Yeah, yields are up. Michael McKee, if you're still there, when I look at retail sales, I get out the calendar. How does this retail sales rapidly adjust a view of Q1 GDP?
Well, we'll get an update of the Atlanta Fed GDP Now tracker in a couple of hours based on this this data. And what's interesting is that a lot of people have thought the first quarter was better than anticipated. You remember Jamie Dimon this morning said consumer spending held up. But Lisa has a good point about gasoline and the nominal price. Gasoline sales down by 5.5% during the month. So there's certainly a price impact there. Food prices down, I'm looking here, food and beverage stores down 0.1, so not so bad there. Where else did we see some movement? Clothing stores down 1.7%. You always have to be careful with the Easter effect around this time of year. And general merchandise stores down 3%. Department stores down 2.5%. So there are some negatives in there, but a lot of this may have to do with falling energy prices as well.
Mike, it's a good point. Mike McKee there on the latest retail sales. Take a second bite at this, Lisa. I think the point that you made just moments ago is really tremendously important. At first look, you've got that headline which delivers a miss. You look to the market and then you see yields higher on a 2-year by 6 basis points. Not a major move in the context of what we've seen at the front end of the curve over the last month, but still higher by 6 basis points, north of 4%. Just go through it for everyone, piece by piece.
Okay, so basically you've got the headline number, a drop of 1% versus the expectation of 0.5%. But then if you take a look at the piece-by-piece components, you strip out autos, you strip out gas, and it's only a decline of 0.3% versus the expectation of 0.6%. This is why people are taking a look at this and saying it's not nearly as weak as perhaps some people had previously expected. How long, when we played narrative roulette, we had what? The no landing, then we had the hard, the soft landing, then the hard landing, and where are we now? Are we back to soft landing, or are we back to the Fed having to go back to 6%? How long before we get back there?
I think we still have to wait and see what happens after the, can I call it a banking shock of the last month?
Tremor.
Tremor? Not a crisis. Okay.
Tremor.
My hand's in correction mode this morning, so I'm going to call it, I'm going to be really precise and careful with my words. After the banking tremor of the last month, we still have to wait and see just to what extent financial conditions are going to tighten. I think that speaks to a new approach from the Federal Reserve, who have implied one more interest rate hike, then stop at 5.1%. They're not going to be in a rush to deviate away from the guidance they delivered just a couple of weeks ago, Tom.
This is a joy of Bloomberg Surveillance with Mohammed El-Arian and John now to bring in Ethan Harris, head of global economics at Bank of America Global Research, and seriously a student of our Federal Reserve System. Ethan, a broad and open question on a Friday. You and Bank of America will adjust to this economic data. What is your theme on the American economy you'll focus in your Friday and weekend writing for Monday morning?
Well, I agree with the commentary here. The number, if you look at the control measure, which goes into our GDP estimates, was actually slightly better than expected. The rest of the report was very consistent with what our own card data was telling us in terms of both the overall weakness of the number and the sectors that were weak. I think we need to be a little careful here. I mean, we started the year off with pretty solid data. Now we're getting a payback into March. And so the question is this the beginning of that slide into recession? I'm leaning in that direction. I think that there's some weakening, fundamental weakening going in the economy. Some of it, of course, was gas prices, which are not really relevant here. But there is some fundamental weakening. And this is before the stress in the banking system. I'm not sure what we're supposed to call it. The kerfunkel in the banking system occurred. And
there we
haven't
go.
seen that kerfunkel. That's the new name. And so we haven't seen the impact on lending. So I do think that the economy will slide into a mild recession some point in the third quarter.
I've got to ask the obvious question. You have access, many would say, to the greatest amount of knowledge on the American banking system that Brian Moynihan and your team have developed. When you talk to the banking bankers, the retail bankers, the commercial bankers at Bank of America, how does that inform your economic analysis?
I mean, we talk to all the businesses. We look a lot at our proprietary data, which particularly on the card data is quite useful for predicting things. You know, I mean, it's way too early to talk about exactly how big the shock is to bank lending from the recent kerfunkel. You know, and we really need to probably should be focused mainly on the regional and smaller banks. We're just going to have to wait and see. I don't think that Bank of America is necessarily the right place to look for where the tightening is going to come from.
Kerfunkel. Mohammed, does that work for you?
I can't pronounce it, so I'm not sure I can.
What's your...
Ethan, I'm really curious. Why is it that the Fed staff agrees with you, but the top Fed leadership pushes back against you in terms of slipping into recession?
I think it's politically incorrect for the Fed to come out and say, hey, you know what? We were too late hiking and we allowed inflation to spin out of control. And oh, by the way, we're going to fix it by creating a mild recession. I think it's very hard for them to make that statement in this political environment. So what they've done instead is they talk about, well, first the staff is forecasting a mild recession. And they talk about downside risks. They talk about the landing zone, you know, shrinking, getting ever smaller. It's now kind of the size of a postage stamp. And I think that they just don't want to fully acknowledge that actually this time around the recession is going to be mainly a central bank story. And I heard your earlier comment about the economy being fundamental health, and I 100% agree with that. The problem is that aggregate demand is too high. As you noted earlier, aggregate supply is not doing that great. Something's got to rebalance here, and it's the Fed rate hikes cooling the economy off.
So let me ask you a little bit more on this. So we now have a difference between Fed staff and Fed leadership. We also have a difference between forward policy guidance that has been reiterated over and over again and where the market thinks the rates are going to go. How long can we live with these differences?
Well, I think they'll get resolved when the Fed shows that, let's say that we do slide into a recession in the third quarter. If the Fed basically sticks to their current narrative, which is we're going to be on hold through the end of the year, the bond market's going to have to adjust to reality. I think the problem with the bond market right now is it's used to looking at recent business cycles where the Fed cut very quickly in the face of recessions. In fact, the Fed cut before recent recessions. But this is different. This is a mini version of the 1980s where the Fed didn't back off from tight monetary policy for a long time because they were trying to get inflation under control. And they'd rather do it with a extended period of weakness, perhaps a mild recession as we're forecasting, followed by a weak recovery, and kind of chip away at the inflation problem, then just hammer the economy and create a major recession. So I think the bond market is wrong. I think the Fed is going to do basically what they're saying in their projections.
Ethan, wonderful to catch up with you. Ethan Harris there of Bank of America, and great call on looking for that softer retail sales print. Ethan Harris there of Bank of America Global Research. Aren't you sick of this? We talked about this on Friday. Mohammed starts to anchor, taking our jobs.
Well,
you know,
there's a value add. You know, I mean, all in all, I mean, what I love about Mohammed is he can go English football and American football.
Just like that.
That's a rare gift.
I know.
Honestly, there was a real statement in that question. I wanted to know your response. That was quite a question. You know, how long can this go on? So what's the answer? How long can this dissonance in the Fed go on?
So I think Ethan's absolutely right. I think what's going to happen is the Fed's going to impose its view, and that comes with a bit of risk to the economy. But I think that's what's going to happen. Their credibility is so low that I don't think they can risk another shock to their credibility.
You think the market comes up to the Federal Reserve again? That's how we reconcile this gap?
The market is more likely to come up to the Federal Reserve than the Federal Reserve go all the way down to the market.
Interesting.
What's fascinating here, and you and I remember this, the Bank of Japan got it wrong, what seems now a long time ago. Is all of this theory infected by that single mistake that the BOJ made, I'm going to guess in 2003? They lifted rates. Oops, we got to come back down. Is there an uncertainty because they don't want to be embarrassed?
So I think that's certainly that, and they'll also cite the ECB, right, coming out of the global financial crisis. So they certainly don't want to be embarrassed again. Yeah. They've been embarrassed several times. You know, we've had the insider trading allegations. We've had the inflation miscall. Right. We've had, I mean, so there's been a series, and we now have evidence that under this Fed, volatility during the market volatility during the press conferences is 3 times as high as it was for previous Feds.
That's because of McKee's question.
I just think Chairman Powell's doing a great job. That was the annual review from Mohammed there. Just top job at the top of the Federal Reserve. Just fantastic. Mohammed's going to stick with us.
What were you listening to?
Erica Nigerian's going to join us in the next hour. Looking forward to this conversation with the equity research analyst over at UBS to talk about the big bank earnings. And the big bank earnings, so far so good. Equity futures negative. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. government is struggling to explain how a 21-year-old man in a junior post was in a position to allegedly leak a massive trove of classified U.S. documents related to the Ukraine conflict. Jack Teixeira, a cyber specialist for the U.S. Air Force National Guard, was arrested in Massachusetts and is scheduled to be arraigned in U.S. District Court in Boston today. The New York Times reports he was the leader of a gaming chat group where the documents first appeared. In a testy public exchange with her Chinese counterpart today, Germany's foreign minister said Taiwan's destabilization would be a, quote, horror scenario, and any change in Taiwan's status would be unacceptable. Beijing has ramped up military drills around Taiwan in recent months. Meanwhile, China warned about the risk of falling debris near Taiwan this weekend following a planned satellite launch, denying Taipei's claims that a no-fly zone will be imposed to the north of the island. A setback for Boeing just as it ramps up production of the model that's a major cash cow for the company. The U.S. manufacturer is pausing deliveries of some 737 MAX jets to address a production issue on the rear end of some aircraft. Shares fell as much as 5.3% after Boeing said it expects deliveries to decline in the near term as it expects those affected jets. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Our forecasts are significantly better than the IMF forecast, but what I should say is that last year we were the fastest growing economy in the G7. We are very confident about the UK's medium and longer term prospects.
What Jeremy Hunt would recognize is that we've actually had a substantial upgrade for UK for this year. It's just that we haven't gone as high as maybe some of the other forecasts are, but we've actually seen things turn out better than expected in the UK.
That was us mediating here at Bloomberg, a conversation with Gina Gopinath, the IMF First Deputy Managing Director, and Jeremy Hunt, the UK Chancellor of the Exchequer, speaking to Maria Tadeo earlier this week.
The Chancellor of the Exchequer is a gifted guy. I mean, he did the London Olympics, no small matter. Probably he's doing the coronation as well. Can he solve the Tottenham problems?
What would you like him to solve?
There's a few of them. I mean, I reviewed the Tots yesterday.
You'd like him to run your transfer?
Find a coach, find a soccer head, which I guess they just brought in here as well. Jeremy Hunt is a really interesting guy. He's a different Secretary of the Treasury, a different Chancellor of the Exchequer.
Hopefully we can catch up with him next time. There's some really interesting moves in this market this morning, and good morning to you. JP Morgan numbers came out a little bit earlier, way better than expected, raising their guidance as well. That stock is up in the pre-market, but yields are flying now by 15 basis points. I talked about a really tight range for the two-year Treasury. Maybe I spoke too soon. We're back to 4.1% on a two-year yield, higher by 14 basis points. And Lisa, as you've pointed out a few times already in the last 30 minutes, look at retail sales once, look at it twice, and strip out energy.
That's been kind of all of the data. And this, to me, is this going to be the big story, the head fake that was energy prices going down that causes a feeling of disinflation that was faster than it was. We also have these headlines from Fed Governor Chris Waller coming out and saying that he actually favors monetary policy tightening more consistently and that the rates are going to have to remain higher for longer because the progress on the core, again, this goes to sort of stripping out the more volatile segments, has not been good enough, which really goes to what Mohammed was saying. Where do we see some reconciliation? Does the bond market come up to the Fed, or does the Fed go down to the bond market?
And Mike McKee, you've been working through some of those headlines from Waller this morning, from Governor Waller. What do you see, Mike? And good morning.
Good morning, John. Well, a fairly hawkish speech from Christopher Waller today. He's noting that inflation did come down a little bit in the CPI, but it didn't impress him. He thinks that it's still way too high, and he notes that the Fed has raised rates to dampen aggregate demand, but consumers and businesses are showing remarkable resilience. And he said this growth would mean that so far, tighter monetary policy and credit conditions are not doing much to restrain aggregate demand. He says there's more work to do. Rates will have to go higher, and as Lisa pointed out, stay there for longer. It almost sounds as if he is saying we could go more than once at this point, and that may be what's helping contribute to the two-year yield rising the way it is this morning, because he's certainly on the hawkish side. Austin Goolsbee on CNBC, he is a voter this year, the Chicago Fed president, saying we still have to address inflation and get it down, although he sounds a little bit less hawkish. He's been the most dovish out there lately, saying that there has been progress made. But right now it looks like Governor Waller is leading the hawk parade.
Mike, thanks for that. Mike McKee on the latest Fed speak off the back of the latest data in the United States. And here's the latest move in the bond market, up 14 basis points
two-year
on
yield.
a two-year, 4.11% on a two-year yield this morning, Tom.
It's fascinating. We got the right guy to talk about this. Mohammed El-Arian really out front on suggesting that we needed quarters ago, some form of interest rate regime that Mr. Waller's still trying to catch up to. Your comments, please, on a really informed generalist in economics saying that we just got to keep it going.
So when you have a 5.6% core inflation rate and it's not coming down, you have an inflation problem. Yes, headline came down to 5.1, but core is what people really look at. I think what we're going to find out, and here let me put myself, is over the next 3 months, the debate over whether we slip into recession or not slip into recession is going to fade relative to the debate as to how does the system adjust to higher for longer. And that's going to be the key issues. And for the marketplace, it's going to be technicals dominating fundamentals, because there's going to be real question marks as to some of the business models, the viability of some of the business models.
One of the bombshells underreported is the former Vice Chairman Richard Clarendon in The Economist magazine saying we're not going to get back to 2%, something in the vicinity of it. This is a debate. You and I are going to be on a panel here in a number of hours with just a set of wonderfully esteemed people, and the core debate is this magical R-start. I love what AEP says about it. He calls it the neutral Goldilocks.
Right.
Where is the neutral Goldilocks?
So I am in the camp it's higher than what it has been in the past. The key issue is not whether we ultimately bring down inflation, is at what cost do we bring down inflation to the economy and to financial stability. That's the key issue.
We're talking about the Fed trying to regain its credibility. And we heard from Chris Waller, a hawkish tone. We're seeing a little bit of a pop in a two-year yield. It still is far below their expectations. We're still pricing in almost 100 basis points of rate cuts. How can the Fed regain that with actions without taking rates to, say, 5.5% or 6%?
So when you have a problem of analysis, of forecast, of communication and actions, you lose control of the two-year yield. The two-year yield is not supposed to be doing what it's doing. I don't think we quite appreciate what it means to have that sort of volatility at the front end of the curve. It makes cash management really complicated. We're not supposed to, the two-year yield is supposed to be anchored to a large extent by the Fed.
That's insane.
It is insane. These sorts of moves today, that's insane as well. That shouldn't happen. And that complicates cash management. The minute you complicate cash management, you start creating all sorts of things. So look at the technicals of the markets, because I think that they're going to be really important for the next few months.
Well, you've said a few times that the Federal Reserve has gone from being a source of stability to a source of volatility. It speaks to the moves you're talking about. Mohammed, we've got a few minutes left with you. We're at the heart of the International Monetary Fund. It's an institution that I know is close to your heart. You're no longer part of the IMF, though, and you're speaking a little bit more openly about the failure of institutions over the last several years. How do you make a room like this, a little bit later, the good and the great are going to sit on that stage and have a conversation moderated by the same establishment journalists we've heard from a million times, including Tom Keene. And they're going to ask the same questions we've all heard a million times. And they're going to come out with the same answers we've all heard a million times. How do we finally break the groupthink of events like this, conferences like this one, like the World Economic Forum in Davos, Switzerland? How do we change this stuff? Because ultimately, we all sit around with the happy talk and we end up with these decisions that cause these volatility. How do we change this?
By making a huge effort to have more cognitive diversity. And it starts at the Fed. I've been on record saying the Fed should pursue the Bank of England approach of having two external, independent members of the FOMC. The ECB is lucky because the ECB gets a range of views because of its construct. The Bank of England has the confidence of bringing in external members. It's not always easy, but it contributes to cognitive diversity. The Fed has not. And therefore, you get groupthink. I think you have to start at the core of the system. These meetings, the real discussions happen not on stage.
Behind closed doors.
But happen behind closed door. And I think there is a different tone of discussions behind closed door than there is on stage.
I would suggest, John, with the media that we have today and now the new immediacy of the media, you get back to Ruchir Sharma's The Rescue Culture, where all of these well-meaning public officials don't want to be the one to create pain. Can we do it pain-free? There's a bank with a marketing scheme wrapped around a banking wrapper out near SFO. Can the big bank step in and pony up $30 gazillion so there's no pain?
But Tom, to the point of rescue culture, and I hear what you say, Who got wiped out in the last month or so? Investors got wiped out.
Investors took $700 million just to one of the Japanese banks.
We're talking about the failure of regulatory oversight, the failure of monetary policy over the last 12 months. Who lost their job?
Well, yeah. I mean, yes.
Where is the accountability of the people that attend an event like this? There is none.
Yeah.
None whatsoever.
I mean, we're going to run out.
Chairman Powell failed on inflation and got a second term.
He did. We are in a point where you have to ask who's going to be harmed. For example, Mohammed, very simply here, the Swiss outrage over 3 banks in Switzerland becoming 1 bank in Switzerland over 20 years. And that, the Swiss people, are they the losers?
I think the big losers are the people who are less fortunate to begin with.
Yeah.
Inequality of income, wealth, and opportunity is what suffers in a world like this.
Mohammed, well said. And thank you for being so generous with your time.
Well, thank you.
Fantastic as always. Thank you, sir. Mohammed El-Arian. Counting you down to the opening bell. Equity futures slightly negative. Yields a whole lot higher in the bond market. Eric Nielsen of UniCredit joining us from the IMF in the next hour.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live, and it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
can't declare victory yet. The great inflation isn't over until the Fed says it is.
Our expectation is that inflation will be conquered over time. It's not going to happen immediately.
The notion that this is inherently an inflationary economy is not obvious to me.
The Fed can't relax at this point on the inflationary front, even though, from the credit front, it probably should be a little softer.
Financial conditions have tightened to some extent, but it's really in the banking sector that we have seen most of the tightening.
This is Bloomberg Surveillance, live from the IMF spring meetings in Washington, D.C., with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Closing out the last day of our coverage from Washington, D.C. for our audience worldwide. Good morning, from the IMF's global headquarters in the nation's capital. This is Bloomberg Surveillance, an extended edition, 1 extra hour TK. Tom Keene, Lisa Abramowitz, and Jonathan Ferro. Equity futures right now on the S&P negative, about 1/10 or 0.2%. A little bit earlier in the last hour, 30 minutes ago, we had some retail sales which lit a fuse underneath two-year yields, and Governor Waller laid it on thick. Some hawkish Fed speak, Lisa, just moments ago.
Yeah, basically saying that we have to raise rates further and potentially keep them there for longer. Again, reiterating a tone that we've heard from John Williams of the New York Fed, perhaps not among some of the other areas, including Goolsbee. What could they do to get the market to believe them? Because yes, we're seeing two-year yields pop, but not all that much considering where they want them to go.
A little north of 4%. We were at 4.1% moments ago. So that's the bond market, the data the Fed speak out with. Tom, earlier on this morning, before that, numbers from JP Morgan. Let's pause. Q1 starting in a pretty phenomenal way relative to expectations for the major banks, with JP Morgan beating on the first quarter, Tom, and delivering a raise to their guidance. And I think the raise to the guidance was the unexpected piece of all of this.
The summary of the two is to meld it together. We talked to Dr. O'Larian about the complexities of productivity. Michael Rosenberg at Bloomberg years ago, and John, within 14 days, the study he did was so important, the IMF picked it up. It's the Bloomberg Financial Conditions Index, and moments ago, it went from a negative statistic over the zero line to a positive. That's not what Jay Powell wants. It is signaling a trend of accommodation within the system, and part of that is the excellence of JP Morgan and other banks, but it's moving away from the published and visible restriction that these central banks desire.
I think we have to be super careful, very careful about drawing too many conclusions too soon about what's going on in the financial system based on the earnings of these major players. Lisa, there are some indications, some people are drawing conclusions already, that these major banks have benefited in a massive way from the, what are we calling it, the tremor of the last
banking
month?
tremor.
No crisis anymore.
Kerfluffle.
The banking tremor, kerfunkle, whatever. Okay, I'll pick another word. Of the last month, they're taking in deposits when other people are losing deposits. I think we still want a bigger flavor, a better flavor, a sense of what's happening in the regionals. I'm not sure PNC is quite the right indicator for that a little bit earlier.
Smaller companies account for the majority of the employment in this country, and smaller companies disproportionately rely on regional banks in order for their credit. We are seeing a view of the biggest banks and the biggest companies and their lending impulse, which is strong, and we know this. The question is the gains that we have seen, are the gains, is the strength in some of these big banks coming at the expense of smaller ones, or is it a good read on what's potentially benefiting all financial players? We just don't know yet, and I think that really is the question.
The good news is that things have calmed down. If you look at the recent indicators around the kind of numbers coming out of the Federal Reserve at the moment for the banking system, things are a little bit more stable. I think stable was the word that PNC went with a little bit earlier this morning. But we can conclude, and Mohammed even went as far as saying, yes, he won't call the last month a crisis, but ultimately this should lead to some kind of tightening of lending standards and should be hurting growth further down the road.
No one is suggesting that's not the case. My question is, are you going to see a divergence with the big banks consolidating their power at the top and their strength, not indicative at all of some of the weakness that will come with that credit contraction?
One of the themes, and a theme of the panel I'm going to be doing here in 90 minutes, and this is mostly from Olivier Blanchard, is there's things we can't see. Jerome Powell can't see them. Our esteemed guest can't see them. Peter Bookvar highlights this with some moldy retail sales. Online sales were flat, but still up 14% year over year. And I would suggest the mystery for everyone at these meetings and in the banks, including JP Morgan, is the technological overlay. Each and every day, what technology is doing to us, business and government.
Tom, it's also the inequality between large and small in the banking system and the wealth inequality in society as well. You know what I'm about to talk about. LVMH and Hermes. those numbers that we've seen from the luxury players off the back of China reopening have just been absolutely phenomenal.
And reading the first reports from Bloomberg Intelligence, what to me is absolutely stunning, is Hermes says these dynamics weren't because of China travel. This is an interior recovery by China wrapped around the Chinese New Year. John, I know you celebrate it extensively, but the bottom line is, in the Chinese New Year, you got to go buy a new scarf. That's what it comes down to. This was an interior success for LVMH, not about the travel that we saw
you hand down money
2019.
Chinese New Year. Isn't that what you do?
Evidently, you buy Hermes scarves.
You hand it anyway.
Yeah, you do. In red envelopes. And then you,
Thank you, Lisa.
yes.
For Lagarde, I've got one on today.
What's that?
This is an
A red
Hermes boat.
envelope.
Oh, is it? Okay.
Yes, it's you know.
Very on brand. Okay. Aaron Cannon with us now, CEO of Clear Harbor Asset Management. Lisa, pull it together.
Thank you.
Aaron, thanks for being with us.
Never says that to me.
Talk to me about the numbers we got a little bit earlier, the data specifically, and then we'll turn to the earnings. What are you taking away from retail sales and what we heard from Governor Waller just in the last 30 minutes or so?
Sure. You know, I think the retail sales data, you know, I think Lisa probably hit the nail on the head. There was a lot of sort of energy woven into that. And so take that with a grain of salt. But if you look at this sort of broader schematic over the last week or two, the data has certainly deteriorated, whether it's the PMI data on the manufacturing side that we saw hit 46.3 a week ago Monday, or, you know, whether it was the railroad car data that we've been looking at. There's plenty of reason to be cautious here on the economic front. Economic activity has certainly been on the weaker side. As it pertains to Waller and Al and Mr. Goolsbee out in Chicago, you know, clearly the last thing the Fed wants to do is suggest that their work is done when it may not yet be done. They may be in the 8th inning and the market thinks they're in the bottom of the 9th, but they only have another rate hike or two to go. And I think that's the sort of challenge of the Fed at the moment, to maintain legitimacy around fighting inflation, even though inflation pressures are coming down too. You look at CPI, the last 9 months of CPI on an annualized basis is only 3.25%. The prior 6 months through June 2022 was 10%. Inflation trends are moving in the right direction. And the Fed knows that, but they don't want to call the all clear signal yet.
Aaron, do you feel like you have a clearer sense of what the banking scenario really is after getting the earnings of JP Morgan, Wells Fargo, and Citigroup?
Well, I think the narrative has probably been correct this morning, which is we're looking at mega banks and the mega regional and PNC, and we're trying to deduce tea leaves out of what happens in a week or two from now when we start to see the regional banks report. I do think there's going to be a huge bifurcation in regional bank earnings. We're going to see several dozen banks maybe appear a little more stressed than the vast majority of the banking system within the regional banks, right? So you have still huge levels of diversification within regional banks, and you have most deposits that are insured. And so I think that's the good news out of the regional banks. The bad news is deposit flight. You saw that accrue here on the margin in earnings this morning. Now, deposits are still down, and why is that? It's because, well, if you look at, if you have a wealth management account at JP Morgan, you're not probably putting your cash in deposits, you're putting them in T-bills, and so that natural outflow has occurred. I think Wells Fargo had deposits drop about 7% year over year. So we're going to see a tale of two stories within regional banks in a week or two, and a tale of two stories within the mega center and the regional banks.
Aaron, you've got a wonderful fixed income heritage, and I think of your Yale University, where basically the endowment taught us that you got to be in the market to find success. We've all got an Ibbotson tattoo on our left arm. What I want to know, Aaron, is what's the enthusiasm right now for equity markets? I don't see much enthusiasm out there in greater America for owning stocks. Am I right on that?
Well, Tommy, you point something out very importantly, which is that the market has been climbing this wall of worry. And, whether it's here or in Europe, I mean, gosh, think about 3 months ago, waltzing into the new year and thinking European equities would be outperforming U.S. equities. Well, energy prices have, on the margin, collapsed in Europe, which has allowed for industrial titans to not just survive, but now on the margin flourish again. But speaking to fundamentals, this is a point of caution for me. If you look at the equity risk premium today, it's at about 190 basis points. If we're entering a light to moderate recession, usually that would peak out over 400 basis points. You look at consensus around earnings for the S&P 500 at, let's say, $219. That's 19 times the multiples just before the market opened this morning. And so, certainly not cheap. Well above 25-year averages, and certainly not multiples you see during a recession. So I think the concluding thought is that if you think we're entering a recession, the current market dynamic within equities would seem to be overpriced. If you think we're going to avoid one, well, maybe we're closer to fair value.
And that's the judgment call. Aaron, thank you, sir. Aaron Cannon there of Clear Harbor, framing it up for everybody. Take your pick your poison. Right now in the equity market, just a bit softer on the S&P 500 earlier on. That move sticks down 0.2%. Standout move this morning, though. Yields higher, Lisa, by 10 basis points, a little north of 4% on a 2-year, on a 10-year up 5 to, let's call it 350.
Consumers stripping out energy costs look better than expected in terms of, or not as bad as expected. And all things being equal, basically, the market is caught between a hot rock and a hard place with respect to these earnings from the banks. If they do well, does that mean there's ongoing strength in the economy? And then does the Fed have to hike further?
Stuck between J.P. Morgan and Governor Waller, I'd say, this morning.
Yes.
Governor Waller sounding pretty hawkish. Diana Ramoa joining us very shortly from Kirkus World. Looking forward to that conversation in just a moment. Live from Washington for our audience worldwide, with equity futures down just a little bit, counting it down to the opening bell about 20 minutes away in New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Chinese leader Xi Jinping met visiting Brazilian President Luiz Inácio Lula da Silva today in Beijing. On the trip, which comes a little more than a month after Lula visited Joe Biden in the U.S., shows the importance given by the leftist leader to both countries. Now, his visit to Huawei facility on Thursday sent a message that he won't pick sides in the U.S. fight against the Chinese tech giant. While the fate of mifepristone, also known as the abortion pill, plays out in U.S. courts, healthcare providers have another drug they can use. Misoprostol is primarily an ulcer medication, but it's also used in conjunction with mifepristone in 98% of all reported medication abortions in the U.S. It can also be used on its own, and multiple healthcare providers say they'd subscribe it if mifepristone disappears from the market. Dozens of advocacy organizations and children's safety experts are calling on Meta to terminate its plans to allow minors into its new virtual reality world. Meta is planning to invite teenagers and young adults to join its metaverse app, Horizon Worlds, in the coming months. But some argue that young people could face harassment and privacy violations in the virtual reality app, which is only in its early stages. And OPEC Plus production cuts are likely to drive up oil prices and inflict more pain on consumers already squeezed by high inflation. That's according to the International Energy Agency. It says global oil markets will tighten more than previously expected, forcing heavy inventory withdrawals of about 2 million barrels a day on average in the second half of the year. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
We've had 3 stages of this tragedy. Stage 1 was too loose for too long. We should have started tightening policy significantly a year ago. The second problem is that after this whole long period, the Fed mischaracterized inflation. When you start late, you end up going higher and staying there for longer. That is the logic. So of course, this interest rate cycle has been mishandled. Of course, it has had an impact on what we are seeing in terms of not only financial turbulence, but also what we're going to see in terms of economic turbulence.
Just the brilliant Mohammed Al-Arian there of Bloomberg Opinion and of Queen's College, Cambridge. What's the joke, Lisa? Something like, other than that, how was the play, Mrs. Lincoln?
Yes, exactly.
Something like that. You know, I was just thinking
Kind of
about
yeah.
listening to Mohammed talking about the economy and the Federal Reserve.
Exactly. So, you know, they got communication wrong. They got how long they waited for raising rates, et cetera, et cetera. So this is really the issue. Why are we not hearing more of that here? And we continue to talk about that. And I thought that you really highlighted that well. That really should be the question coming out of this, because that's where the focus is, the volatility in developed markets.
For a long, long time, Tom, institutions like this one at the International Monetary Fund, and Mohammed was talking about this, very open, very critical of policymakers in emerging markets. Yet when it comes to DM, the Federal Reserve, and the monetary policy failures of officials, policymakers across developed markets, we've heard very little from these institutions.
There is the Red Book, Stanley Fischer, after the crisis of 1998. Everyone at gunpoint had to read it years ago, and it's precisely what Dr. Fischer talked about, is that the pressure of appeasing the people writing the check for these institutions is so tangible that on a day, I don't think our audience understands how the boats floated here by a select number of countries, including 1600 Pennsylvania Street, which is like 4 blocks. So, John, you go to the Hay Adams.
Yeah.
You look out across Lafayette Park.
Done that with you.
Vista.
Wonderful.
Yes.
Look, Mohammed talked about it. Ethan Harris did as well, of Bank of America. Tom, how reliable then is the outlook from an institution like this one? How reliable is the outlook from the Federal Reserve? When Ethan Harris, in the last hour of Bank of America, you and Mohammed, Lisa, you asked the right question too. Why is there this difference between what the Fed staff are projecting and what Fed officials are communicating? And Ethan Harris said, basically, it came down to one thing, politics. He said it came down to politics.
That's always true. I think the criticism is just, apt, but at the same time, it's an institution that has to fold together lots of different opinions and piece them into an aggregate one view from about 150 different views. Right now, Diana Moa with us, with Kirkoswald, and we're going to jump into the EM market debate. Diana, I love your note, and you go into a little bit of portfolio theory there, where you talk about the shift of alpha and beta and EM right now. The fancy CFA types understand alpha and beta, but what is this sea change for your emerging markets?
So there's a couple of things that are happening. From a top-down perspective, I think the conversations we're having are pretty interesting, where you look at what's happening in the US, policymakers are still grappling to see where they are in terms of growth, inflation, et cetera. In EM, we started hiking rates well before the Fed hiked. So 13 out of 20 of the major emerging market economies had hiked before the Fed were even starting to move their monetary policy. So that's one part. So the conversations, the big sea change from an EM perspective is now we're asking policymakers, when are you going to start cutting rates? because inflation appears to have peaked in a huge number of emerging market economies, and real rates are actually rising up. So that for us is a big sea change.
A focus today is the debt external, dollar-denominated debt, and also debt internal. What is the fiscal stance of the EM economies you look at right now? How fragile is it?
It's very dispersed. You have some emerging market economies that do have fiscal space that can still spend to keep growth going, particularly in parts of Asia, where they actually did not do as much fiscal spending as we saw in the the developed markets and in EMEA and LATAM. So there is room there from a fiscal perspective, but it's very dispersed. I think where we see vulnerabilities is in the low-income countries. And that's the discussions we've been having this week in the IMF. What kind of support can the MDBs provide some of these low-income countries, given they're still struggling with the impacts of the events of the last 2 years, and they have limited fiscal space?
There's a traditional thought in investing that during some sort of recession, particularly in the U.S. is still a better place to be than, say, the developing world or in Europe or outside of the U.S. Is this time different because of some of these policy divergences with the developing world, frankly, getting out ahead before the developed nations?
100%. I wouldn't say it's necessarily different, but I think the issues coming from DM are much more pronounced this time than we've seen in previous cycles. Whether we're looking at what we saw with the regional banks, that was a very US-specific issue, US and Europe to an extent, whereas EM was much more insulated from that. And, looking forward, discussions around the debt ceiling, that's going to be another, pretty volatile period. So is Treasuries really a safe haven in that sort of environment? I think you look at quality duration outside the US to diversify your portfolio.
Do you feel the sort of gravitational force away from the dollar and away from dollar-denominated debt in a way that you really haven't before?
Not necessarily away from dollar-denominated debt. I think from an EM perspective, one of the most interesting things that are coming out of the discussions in the IMF is there's more of a push for local, when you're talking about restructuring, local debt restructuring is coming into play as well. So it means in the past where you think in a restructuring, it's going to be the dollar-denominated debt, this time both the local and the dollar are coming to play. So for us, we don't necessarily see a shift away, but it certainly adds burden to the low-income countries.
Diana, you just said something moments ago that I think is so important. We're sometimes asked, what's the biggest difference between DM debt and EM debt? And I have a very simple cheat guide for that. When things get bad in EM, you run. And when things get bad in DM, you buy the debt of those countries. You just said something interesting. Are we going to change the way we behave towards the Treasury market if we have another debt ceiling debacle later this year? Or do we just reach for the old playbook and buy the debt of the countries that are doing bad things?
So it's going to be a pretty interesting summer. That's my view, because I think if we're, one of the data points that came out in a discussion here was there's something like a 30% probability that you may be talking about potential technical default in the US come the summer, right?
3-0?
Yeah. So that was in one of the panel discussions in the IMF. So that's a pretty high number when you think about it. Do you really want to be buying debt when we're having conversations on, who's going to be paying that bill? Can the government actually get a consensus to pay back investors? I'm not necessarily sure that's the play. So I still think, going forward, how investors think about fixed income will have to evolve. There is a lot of high-quality duration outside DM US rates that is actually paying you to get into the trade, and inflation is falling, so you have both the safety, but the duration rally that's probably going to be imminent.
We've got 60 seconds, we can do this. Let's say I'm a PM, I'm running a fund, I've got a pool of assets that are meant to have some kind of risk mitigation characteristics. Typically it would be treasuries. You're saying I need to diversify. What to? JGBs, bunds, where am I going for that?
I would go for something like Mexican debt. Outside the US. So there's some sensitivity to US growth. And if the Fed is forced to cut rates, the Bank of Mexico is not going to be so far behind. And maybe something in Asia. So those would be my two.
Do you hedge the Mexican peso? I'm sort of thunderstruck in an amateur way of 21.22 out to an 18 peso. Do you prosecute that unhedged or hedged?
I mean, the last 18 months, if you'd been hedging the peso, that would have been a terrible decision. I mean,
Thank
look
you.
at that.
Why
Performance,
look,
right?
I bought the Australian 97 year at the wrong time as well. But this is, this is really important, and this is a complexity to this about what you do with foreign exchange while you play in the AMOA space.
I think you keep the foreign exchange. EMFX, you look broadly speaking, depending on where you're looking at, currencies are up anywhere from 3 to 8% year to date, EM currencies. Again, it's this diversifying view of we already took the pain of currency depreciation. We have high real rates. It's attracting flows back into the markets. You have remittances still looking strong in somewhere like Mexico. So,
John, this is gospel. What she said, I learned this the hard way.
This is one of the most thought-provoking conversations we've had this week.
I absolutely agree.
Diana, thank you.
Thank you.
Diana Ramoa there of Kirkus. You've got a lot to say, haven't you?
I'm just wondering, do you buy currencies and debt of the different poles, of China, of the U.S., like buy everybody and make sure that, if there's tensions, you're hedged.
Where's the policy risk right now?
Exactly.
Where do you want to be? Erica Nigerian of UBS on the big bank earnings this morning. Up next.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
What a busy morning of price action for you. First, it was the big banks then it was the data, then it was the hawkish Fed speak. Going into the opening bell, 15, 20 seconds away. Equity futures still negative by a couple of tenths of 1% on the S&P 500. On the Nasdaq 100 was softer, negative, down lower by 0.5 of 1%. There's the opening bell in New York. Switch up the board and get to the bond market. Surprise, surprise. We had some stability for 5 minutes, and then yields broke out. On a 10-year, by 4 or 5 basis points. Let's call it 350 on 10s. On a 2-year, up 10 basis points. Your yield higher. So north of 4%, let's call this 4.07% on a 2-year yield. The dollar making a bit of a comeback. Euro dollar 110.26, negative 0.2 of 1%. Euro dollar earlier on this morning, a new high for 2023 on that currency pair. Looking out to crude, WTI still north of 80, 82.74, positive by 0.7 of 1% on WTI crude. About 35 seconds into the session, equities just about negative on the S&P 500, down 0.1 of 1% on the S&P, on the Nasdaq down 1/3 of 1%. But check out the banks. Nothing negative about what we heard from JP Morgan a little bit earlier this morning. We had numbers from them, Wells Fargo and Citi, to kick off earnings season in the United States. Shonali Basak has more. Hey, Shonali.
John, we have to start here with JP Morgan because not only did they bring in a record amount of revenue and raise what they expect in net interest income this year, they're also pouring water on your idea of a credit crunch. You have the CFO telling analysts on the call that they're not aggressively tightening standards all across the board. With that said, you did hear Jamie Dimon draw some words of caution here. This idea that 2024 in particular has such little visibility. When you look at what's happening in the supplements as well, you see charge-offs starting to tick up. You see that 90-day delinquencies, for example, in credit cards also starting to tick higher. But the corporate lingo here is normalization. So you're not hearing broad concerns right now. You see it in the stock price movement, of course. You both had Citigroup, PNC, Wells Fargo, all really meeting or beating expectations on all the main lines of business you could think of. We have seen the investment banks until this time trade better than you saw the consumer banks. So you're seeing the consumer banks start to get a little bit of that lift. Remember, coming into today, PNC in particular, John, had been one of the worst performers in the KBW Bank Index. So a little bit of love to start off the regional bank earnings system as well.
Shonali Basak, thank you so much. And on to Monday as well, and continued bank earnings. Right now, folks, and this is important, Global Wall Street leaned forward for the concision at UBS of Erica Najarian. To say she's equity research analyst barely describes a detail of the notes. There's others on the street doing the same thing, but she's doing it with a shocking clarity as well. I want to understand, we talk here at the IMF, Erica, about fiscal space. What is the space for capital appreciation of these major banks? Not the price target per se, but do you see them with a 1, 3, 5-year upside, or is the there now?
So look, this is essentially what JP Morgan showed us today. If you're a strong bank, and there will be weaker banks as we think about the rest of earnings season. If you're a strong bank, you could withstand what's coming. Look, what Jamie said, we don't know where rates are going. The recession is probably a strong probability from here. However, you could still protect your returns if you have strong earnings power, right? And I think those kinds of banks, to answer your question directly, could have upside because the market pays premium for that earnings power, but not just that earnings power, that earnings resilience, even in an unpredictable rate market and even in a recession.
As you study the major banks, and I want to take it down to another bank you cover, and Mr. Wilmers was so kind to me, M&T Bank of Buffalo. Are there a lot of mid-sized JP Morgans out there? Are there a lot of banks run like a Swiss watch, like M&T?
So there are a lot of banks that are extraordinarily well run. And I would say that the regional banks that I cover that are 100 billion in assets or more have to be well run because of the regulatory scrutiny that they withstand every single day. So yes, I mean, the compliment of having another regional bank, Jamie Dimon, is rare. And I would say Renee Jones is probably in that category at M&T. But let me say that a lot of regional banks are extraordinarily well run.
Within that is the idea of combination. Is that the next year? I've got a phrase, and I'm not talking about banks, but the zombie roll-up of the great zombie roll-up of 2023. Even if they're not zombies, are the banks going to be forced to merge?
So I think at the end of the day, the near-term outlook for consolidation is not a very friendly one, right? You have a lot of, potential marks on the balance sheet that you're buying because interest rates are much higher than what, was booked on the bank balance sheets. But I think over the medium term, given some of the pressures that are impacting smaller regional banks, I do see regular way consolidation picking up, but I don't see that as a near-term catalyst.
Erica, we're in Washington, D.C., and we're here for the IMF meetings, and it's very political, and you feel all the politics kind of ejected into conversation. So I look at J.P. Morgan results, and I think, if I were in Washington, why wouldn't I say, all right, fork over some of that cash, and we can bail out the smaller banks as they come up needing help. And you know what? These big ones have plenty to spare.
Look, I mean, at the end of the day, right, the large money center banks have already stepped up, that they were leading the consortium of depositors for First Republic, for example, right? And I think at the end of the day, JP Morgan actually mentioned the upcoming special assessment that could come from the FDIC. The big banks are proving that even with very high capital standards, high liquidity standards, they can earn, a pretty significant return. So I don't necessarily know what that means for, future regulation, but at the end of the day, they're showing, pretty strong resilience, and that might be, something that, perks up the attention in Washington for sure.
Well, this is sort of the regulatory risk overhang, and this is sort of what I hear is the biggest comment, the only kind of skepticism around just buying the big banks and not the small banks is sort of increasing divergence is the regulatory overhang. But do you just lean in and you say, look, JP Morgan, Citigroup, Bank of America, they're all, we'll see with Bank of America, but they're all delivering incredible results. Just buy those shares. They are undervalued, but ignore the regionals because they still could come under a lot of pressure?
Look, I mean, our ratings distribution essentially just summarized what you just said, Lisa, because I think at the end of the day, the rate of change in the regulatory construct is probably going to be wider for the regional banks than it is for the big banks, right? The big banks, in terms of the regulatory standards, are already extraordinarily tight. And while we have Basel IV coming, the CET1 or Common Equity Tier 1 capital prints that Wells Fargo, JP Morgan have put up in the first quarter essentially says they have the earnings power to build that capital organically. And unfortunately, the regional banks are a little bit behind, right? PNC, for example, was at 9.2% CET1. And I think the capital floors for the regional banks are going to go higher. And I would suspect the market is going to expect that they need to be at 10.5%. So yes, I think the big banks at their current valuations and earnings power look pretty appealing here.
Erica, just one final question from us. There is some data that comes out in early May. It's the Senior Loan Officer Opinion Survey. There's a lot of people in this market who are going to be fixated on that when it comes out. Can you take anything away from this morning and make a suggestion as to what we might see, or rather might not see, when that comes out in early May?
Yes. So belt tightening is natural, right? Belt tightening is a natural result of tighter monetary policy as funding costs go up and as the probability of recession increases. However, the Senior Loan Officer Survey in May, I'm sure, will show that belt tightening. But I think the severity of the credit crunch, there's a lot of doomsayers in the market right now, is going to be perhaps undermined.
Interesting. Erica, thanks for that. It's wonderful to catch up with you. Busy day next week as well. Busy few days next week with the bank earnings coming in. Erica Najarian there of UBS on some of the banks, and hopefully we can catch up with Erica again in the next couple of weeks. This echoes something we heard from Jamie Dimon of JP Morgan. Now, Sonali does a fantastic job of not just breaking down the earnings report, but also going through the commentary from the C-suite. The CEO over at JP Morgan saying this: I wouldn't use the word credit crunch if I were you. Echoes of Mohammed in the last hour. No banking crisis. Don't use the word credit crunch. The CFO of JP Morgan goes on to say, we're not running around aggressively tightening standards right now. So, Torsten Slock of Apollo, credit crunch has started. Remember that headline? We read it a few times over the last week. Jamie Dimon, I wouldn't use the word credit crunch if I were you.
And the word dispersion that we heard from Erica Nigerian, it's going to be just the crunch or whatever you want to call it. It's like 2 Americas. It's going to be dispersed across 5 Americas of American banking. They're going to be losers out there, but are they, to borrow the Turkish lira phrase, idiosyncratic, or is it a broader system? Certainly Ms. Nigerian made clear she doesn't buy the gloom.
Well, there's a credit crunch, just depends where you look. In Silicon Valley, there's clearly a credit crunch. For startups and venture capital, there's a credit crunch. For commercial real estate, there's a credit crunch, and possibly worse. In the mortgage market, well, there's kind of a question. We've seen some tightening with respect to auto lending. So in specific sectors, there are definite restrictions in lending, areas that aren't as significant for some of these big banks. So they are not necessarily capturing the stress that we're seeing in other segments of the economy. It's really just whether it's going to have a broader effect or not.
Just to recap some of the market action in the early part of the session, about 10 minutes in this Friday morning. Good morning to you. The equity market positive by 1/10% on the S&P 500.
We're positive?
On the NASDAQ, we're negative by 1/10%. A lot of attention on the banks, for good reason. JP Morgan numbers look pretty brilliant relative to expectations and relative to the banking tremor of the last month.
Thank you. Very well said.
Anytime. In the bond market, yields look a little something like this, with a focus on the front end of the yield curve this morning. Your 2-year yield in America, Treasury yields higher by 11 basis points, north of 4%, 4.08%. We're focusing on the banks for good reason. Got to talk about the data as well. Retail sales look softer at first look. As Lisa, you mentioned a few times, on a second look, strip out energy, not as bad. Then you fold into the mix Governor Waller with some pretty hawkish headlines going into the opening bell.
Potentially looking to raise rates further and hold them there. Guys, we're not cutting again and again and again. That's what the Fed keeps saying.
On repeat.
On repeat.
On repeat. Coming up, as we round out and wrap up our coverage here in Washington, D.C. at the IMF World Bank Spring Meetings, Eric Nielsen, Chief Economic Advisor at UniCredit, joining us around a table. Looking forward to that from Washington, D.C. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Some of Ukraine's European allies are increasingly skeptical its military will be able to make a decisive breakthrough this year. Kyiv's allies are reportedly reining in their expectations and considering the need for intense fighting well into 2024. U.S. officials were offering their own downbeat assessment of the outlook 6 to 8 weeks ago, according to a collection of classified documents whose exposure in a leak has stirred anger in Kyiv. Meanwhile, the U.S. government is struggling to explain how a 21-year-old man in a junior post was in a position to allegedly leak those documents. Jack Teixeira, a cyber specialist for the U.S. National Air Force Guard, was arrested in Massachusetts and is scheduled to be arraigned in the U.S. District Court in Boston today. Some trouble for Supreme Court Justice Clarence Thomas. According to a report, Thomas and relatives sold 3 Georgia properties that include his boyhood home to GOP mega-donor Harlan Crow in 2014. ProPublica says that Thomas didn't list the real estate sales in his financial disclosure forms that year or report his extensive travel financed by Crow that occurred over 2 decades. And Bloomberg has learned that Mitsubishi UFJ Financial Group's wealthy clients lost more than $700 million on Credit Suisse Group's AG's riskiest bonds that were purchased through the Japanese bank's brokerage venture with Morgan Stanley. Japan's largest banking group is holding meetings of senior officials to look into the matter as it reaches out to roughly 1,500 clients who lost a combined $717 million. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Is not going to go back to the 3.8% it used to be, but more 3%.
Certainly evidence in the data of some contraction in lending and some tightening of lending standards.
The crisis is coming upon us. A solution is needed. Something has to happen. Everyone's going to have to give and compromise.
I think the one thing that seems to be off the table in the discussions is the role monetary policy has played in creating financial fragility.
It's important to have some accountability in the system. Why? Because that is the basis of political independence. And no one wants to erode the political independence of central banks. But central banks have to own their mistakes.
Just a fantastic lineup of guests through the week here in Washington, D.C. at the IMF World Bank Spring Meetings. Live from the nation's capital this morning. Good morning to you all. TK, what a week so far. And just to round it out, for you, what was the standout?
To me, for the standout is an absolutely original meeting. I said that, I believe, in 08, 09. I remember Jackson Hole looking down the ramp there, you know, and it was a pleasant day. Yep. It wasn't 32 degrees like last year. I'm at Jackson Hole, and I'm looking down, and Stanley Fisher's on the phone, and he's animated. And, you know, that's usually not Dr. Fisher. Same thing here. There's some animated people hiding that they're animated.
To me, it's like walking into a room with a couple that you know is having real problems. And they're not.
And please, would you like to expand on this?
Open this one up. Let's go.
Hold on a second. It's like walking in, and you can feel these tensions, but it's clear they don't talk about it, and they all talk on the same platitudes. But it's clearly there's like tension under that they're not ever getting to.
Are you describing the dynamic around this table?
Let's move on. No, I really am talking about
on a serious point. The United States and Europe, there is some clear tension in global trade. I think that this week, the International Monetary Fund and the World Bank has totally failed to address it. It is the elephant in the room between the Europeans and the US. You speak to representatives of the European Union, and they don't want to talk about it. You bring up the comments from Emmanuel Macron over the weekend. They want to pretend they were never made. We spoke to the commissioner. You just got this impression publicly there's nothing to see here. But we all know there's tons to see here. There is tons to see.
And nobody mentioned the word China is, well, let's try to move on. Welcome at this late day, late moment in Washington to Therapy with Brahma. We're really thrilled to have you. We have the advantage, as John and I try to do at Davos or at Jackson Hole, to finish strong with a qualified individual. Eric Nielsen carried the optimism of Europe at UniCredit in the darkest days of a number of years ago. He joins us today with the perspective of his public service at the IMF on the Turkey and Russia watch as well. You were in the trenches years ago of IMF duties. Is the IMF focused right now on fixing these debt crises, or are they completely distracted by the therapy that Lisa was talking about moments ago?
They feel distracted. I share the sentiment you said. I have been to probably 50 of these meetings over the years, and I cannot recall such a division between what the IMF writes about, what they talk about, what the official sector talk about, and then you go out of this building and meet in the private rooms with private investors and other private sector people, And they all talk about Russia, China, and then to Europe, right? Sorry, US, China, and the war, and then Europe. Here we talk about we need to do some fiscal retrenchment, we need some monetary tightening, inflation a little bit too high, and then we were lucky, we had a financial mini crisis, so we can talk about financial stability, but it's not really a problem, as we can have heard, and I agree. But that's what they talk about. They don't talk about the elephant in the room, that fundamentally economic policy of 30 years is out the window. We are no longer having free trade. We no longer have beliefs in free capital movements. We now are talking about industrial policies, sanctions, but they're not leading the discussion here.
And this institution was meant to be the very embodiment of that push.
That's right.
So what's gone wrong?
That's a good question. Let's first recognize that they're in a difficult spot. They have shareholders on both sides of the debate, right? But and they don't have a history of having criticized the US and China. You can't find it in the back, right? That doesn't happen. And these are the two big issues, right? And they don't really talk about it, right? This is they need to be brave. They should have been brave. They were not here. I think they missed their opportunity.
Tom talked about this repeatedly through the week. Tom, you brought it up so many times. The absence of China.
Well, the absence of China here, and long ago and far away, the managing director told me on her trip, they at least began to engage discussion. And the word they use, which you have lived, Dr. Nielsen, is technicalities.
Yeah.
Is this going to be a process forward of technicalities, or is it going to be real leadership by Secretary Yellen, the managing director, by the Chancellor of the Exchequer, and indeed by the leadership in Beijing?
This is I don't know the answer how they would do it, but they're not there now, right? It is there are two good chapters from the IMF on sort of geopolitics, right? There's one in the WEO and one in the Financial Stability Report. They are about the effect on foreign direct investment this could have and estimate what it is. There's no policy conclusions. There's no sort of economic effect conclusions of it. So it's technicalities. Economic sort of analysis, interesting,
Lisa,
great start.
I totally agree with this.
Well, so is this basically a crisis of leadership?
Yeah, I mean, ultimately, yeah. I mean, maybe, but it's possible that the deck of cards handed here is unplayable because it's America and China, right? But yeah.
But what's the consequence then? I mean, honestly, what is the relevance then of the IMF if you have a situation where they're not taking a policy stance, they're not calling people out, they're not creating a vigorous debate at the beginning?
They're calling out the UK. Yeah.
All right, okay.
That's what's, and a lot of people in the UK, for obvious reasons, are very upset by it. Now, I think, Eric, we can sit here and agree that some of the policy issues of the UK quite rightly needed to be criticised over the last 10 years, and we can find some common ground there. But why are they so comfortable going after the United Kingdom? And then when Chair Powell walks around here, it's like, don't say anything, it's fine. There was no failure there. We can't talk about that. What is that about?
Yeah, it's about power, right? And who you want to please, right? It's and they haven't, at least at this stage, been willing to step up. Back in the Latin American debt crisis, De La Rochère today, still in his high 90s, would tell you stories about how he walked down the street to the Treasury and according to him at least, worked with them and made things happen. We don't quite see this now, I think.
So what's the consequence?
Well, the easy consequence is that this institution and the World Bank will be on the back seat and not in the driver's seat, if they even will be in the car, right? This is the issue, right? The world has moved on in a very dramatic way. I think the 30 years of globalization, where economic policy was set by sort of the ideas that we economists believe in, free trade and these sort of things, that's not there anymore. It's the security apparatus or agencies who have taken over. And maybe that's real life, and that's just what it is. But the result of that is that economic policy is not in the driver's seat anymore. This is just not talking about it.
Let me dovetail. Gore gave a week ago with a stunning 5-year view with some of the zeitgeist this morning, and that would be a study of nominal GDP. You are the optimist, but can you frame out a reduced real GDP along with a reduced inflation?
Yeah, you can. I mean, this is sort of an economics argument that is based on the base case. And when I talked to a staffer here, and he defended what they've done, he says that in the publication is that you have fundamentally to articulate a base case. The problem is that there are so many risks around it that one of them is bound to happen. But I think the problem is bigger still, because I think the whole narrative of economic policy making and who runs the show today has changed, or is changing. It's changed now. And this is not, so then we can talk about that growth. Maybe global growth is going to be 2.8 or 2.7%, and maybe the neutral rate, it's going to come down a little bit, and the central bankers don't like it, right? And they kind of think, oh, now we want to tighten monetary policy. That's a sideshow. It's a sideshow. It's not the real story in the real world. The clients we talk to, European corporates, other corporates, are like, this is not what they talk about. This is, inflation is coming down, and yes, we can discuss whether it's 25 basis points, one or twice, or whatever.
Yeah.
That's not the real story.
Can I get to the most important question of the morning? What was better, the $8 Stracciatella in Washington, D.C., or the €3 Stracciatella back in Milan? Which one?
It was very good, the one I had yesterday, I have to say, but most of it landed on the sidewalk.
Have you not seen that tweet? It's a great tweet from Aaron earlier this week. He said this: greetings from the IMF spring meetings in DC, $8 for a Stracciatella ice cream, which is almost as good as the one you get in Milan. What went wrong? Did the Fed allow US inflation to run away? Then raising questions about Euro-dollar. Eric, this was great.
Sure, thank you. Great way to end this. Thank you.
Great way to end the program here. Tom, things don't end for you. A fantastic panel coming up a little bit later.
I think we're going to have coverage of it. This is a world-class panel, including Ella Arian, Olivier Blanchard, Gopinath of the IMF, but very importantly, grizzled and experienced voices of Korea and Argentina as well.
Thank you to the guests and thank you to the team for putting on this wonderful production here in Washington, D.C.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we've seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard, In America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. and it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking, the bus was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. he emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about. This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
This is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech in right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just attacked that video and were like, you explain things so much better than my boyfriend or my professor, or I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, The hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350. Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African-American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest flight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor. Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, and language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings. As well as you're going to describe about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be in the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into a medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. At Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities, and most of them got institutionalized now. So, for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change all that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university, and then I faced worst form of discrimination in the universities. There were in those days I'm talking about. So the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand, and then again try to excel in academics day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park. And a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planted terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. We have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore, if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right? As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, This is actually going to be money.
How did the YouTube